Hello, everyone. My name is Corey Daharsh. I'm with Advanta IRA, and I'm here to bring you today's educational webinar on the basics of self-directed IRA investing. So we're going to be covering a very general, broad scope view of what self-directed investing is, how you can get these accounts funded, the types of investments you can look to make with them, and I'll also be happy to answer any questions you may have throughout the presentation. Just to give you a little bit of information about me and my background, again, Corey Daharsh. I have the designation in the industry of CISP, which is Certified IRA Services Professional, back in 2018, but I have been with Advanta IRA since 2016. And in my time at Advanta IRA, I've done a number of different roles. I've worked in the accounting department, processing transactions. I've worked as a client account manager, fielding calls and assisting clients to execute their investments. And now in my current role as a business development specialist, I do educational content, networking, a lot of traveling, and kind of building some of the knowledge base and presence of directed investing. All of my contact information is here. I will share that again at the end of the webinar. This webinar is also being recorded and will be posted on our YouTube page. That's Advanta IRA at YouTube. So if you want to listen back or watch this at your own pace, pausing and whatever you may need, that will be available within about 24 hours of this live recording. One other aspect I want to make sure everyone's aware of, you will be muted through the duration of today's webinar, but I do want your participation. So if you have questions, please use the questions box in GoToWebinar. I will be able to see those. As long as they're relative to what I'm presenting on at that point in time, I'll go ahead and answer them as I go. If they're not relevant, I will hold them to a questions slide at the end of the presentation. And if they're super irrelevant, I may reach out to you after the webinar, or you could reach me after the webinar and we could go over whatever those questions may be. So without further ado, I'm going to move forward with the presentation here. We do have a brief disclaimer. I'm here to provide educational content. Myself and Advanta IRA do not provide any investment advice or endorse any specific products or investments or anything of that nature. We always implore you to do your own due diligence. That means building and utilizing your own team of professionals, whether that's attorneys, CPAs, accountants, financial advisors. Make sure you're comfortable and confident. Again, this is self-directed investing. So you are the fiduciary or financial guiding light for your own retirement investments when you choose to self-direct. So make sure you're very comfortable and confident with the team you put around yourself to do that due diligence and vet everything out. Advanta IRA is a self-directed retirement plan administrator, and we serve clients nationwide. We really have clients that live internationally as well that I deal with. But just for context, we provide our clients with exceptional personal service, experience, and a knowledge base that is paramount in administrating self-directed retirement accounts. Again, I referenced earlier, I have a designation called a Certified IRA Services Professional. That type of designation does require continuing education credits to stay up to date on an annual basis, and a lot of our staff have that designation. So we are industry experts in what the IRS does and does not allow you to do with your retirement account. We are not financial advice experts or tax experts or things that I mentioned on that last slide. We're here to help you maintain your investment goals and strategies within the IRS's rules and regulations. We've been around for just over 20 years. Last year, 2023, was our 20th year in business. We have about 2.5, a little over 2 billion in assets under management held by our clients. All of our clients' funds that are not actively invested are insured up to FDIC limits. They're in basic trust bank accounts, waiting for your financial directive or investment directive to move forward into a deal. And every client that we have is paired with a client account manager that's basically your go-to one-to-one concierge style personal person that's there to answer all your questions. Again, I served about 5 years in that role. That person really builds a knowledge base of who you are and what you're looking for, and some comfortability in knowing how you're going to get your questions answered. And from our end, knowing when I see one of my clients call, what type of questions they may be calling to ask about. what type of investments that person is very familiar with and prefers to make. So it's a really great way that we stand aside from others in our space by giving that white glove, if you will, service. So what is a self-directed IRA? A lot of people say they have a self-directed account when they're with a fiduciary or a managed custodian, but really in that capacity, they're being sold on a marketing term, and they really just have an account where they're allowed to pick from a list of maybe 20 different stocks, bonds, mutual funds on a platform. And that's not a truly self-directed account, to be honest. A truly self-directed account is where you can invest into anything you want to with your retirement dollars, and your administrator does not tell you yes or no. They simply help you facilitate it within the IRS's rules and regulations. I'll get into those rules and regulations in a few slides, but I just wanted to outline a self-directed account. A truly self-directed account is one where you make the financial decisions and no one is over your head saying, yes, that's a good idea. No, that's a bad idea. Yes, you can do that. No, you can't do that. A few of the asset classes include real estate, paper asset like mortgages and notes, private placement, also known as private equity investments, precious metals, foreign currency, futures trading, and much, much more. There's a very wide array of things you can invest with your self-directed funds. It's more so important to understand what you're comfortable with or what you have interest in. Obviously, you're going to do more due diligence or be more eager or intentional in your investing if you're going into something that you specifically have interest in, as opposed to letting a financial advisor put you in the market into XYZ fund when you actually know, hey, I support XYZ, or I have a specific personal interest in XYZ, or maybe I've already been investing in XYZ with personal funds, and now I'm learning I can also place my retirement funds there. So that's kind of the gist of what a self-directed IRA is. And if you have not heard about a self-directed IRA or a self-directed account, that's very common. Don't feel like you're out of the loop or anything like that. Most people are out of the loop, to be honest, because those larger fiduciaries or financial advisors prefer not to let you know that these types of plans exist, because they want you to keep your money in their possession in a managed capacity where they're charging you a rate or interest on your investments or points, something like that, to control your money for you. Of the whole US-based retirement account industry, there is roughly just under 40 trillion with a T, dollars in IRAs, 401ks, US-based retirement accounts in general. Only about 4% of that are currently being self-directed. So again, a company like Advanta IRA that puts out a lot of free educational content and tries to be a good steward of our industry by providing great customer service, does the legwork of trying to expand people's knowledge about these types of investments and opportunities so that you can then share it with your friends, your family, whomever you think could be a good candidate for a self-directed account and maybe would like to take advantage of these things that they just have always been available, but maybe just didn't know about. So some key takeaway points I want to share right now are that any IRA or former employer plan can be used to start a self-directed account. In most cases, that is not a taxable event. In most cases, there's not even tax reporting done when you move funds into a self-directed account. I will break that down a little bit further in a few slides, another little piece of foreshadowing, but any money you have in a retirement account can likely be moved into a self-directed account very easily and relatively quickly as well. You choose the investments and conduct all of the due diligence. I know I've said that a few times already. That's something I'm going to hit home multiple times throughout the presentation because, again, self-direction is the first words we're using here. You're the self, you're in control, you're directing whatever you make as an investment with these types of accounts. And then all expenses relative to investments and income generated from the investment must flow directly into and out of the retirement account. That is to say, if you make an investment, you should not be personally receiving the income it generates to forward along into your retirement account. It shouldn't be getting any capacity touching your personal bank accounts or anything like that. should all flow straight through this retirement account. And likewise with expenses, you, for example, own a piece of property and you have a bill come for that property, you should not be cutting a check or sending a deposit from your personal bank account. That all needs to be routed through the retirement account for proper reporting and IRS protocol. Now, I do see a few questions. Let me read through these real quick before I jump into the next slide, breaking down the types of plans that can be self-directed. Who holds the precious metals after purchase? For that, precious metals do need to be held at a safety deposit box or a secured facility. You cannot hold precious metals owned in your retirement account personally. We have separate content, both in webinar capacity and on our website, that breaks down more specific precious metal investing information for that person. If you're interested in that, just shoot me an email and I'll be happy to point you in the direction of that specific content. Next one here, I have a self-directed IRA. Is it mandatory to have an LLC to use/invest in some of the funds? It is not mandatory to have an LLC. I'll get into what that even means for some of the other audience here in a little bit, but what this person's referring to is likely a checkbook control IRA or a single member LLC. It's a great investment strategy for some people. For some people, it becomes a little bit more tedious than they may be interested in, but I'll explain that a little bit further and break it down further for you later on in today's presentation. And then the final question I see listed right now is: a current employer does not participate into a self-directed IRA. Can you still use a regular 401k and invest into a self-directed IRA? So there's a few different things to break down there. If you're with a current employer, that has no bearing on you setting up an IRA account, and I'll go over that in the next few slides, but just to answer this question directly, anyone can have an IRA account. That has nothing to do with an employer. A 401k, however, is an employer-sponsored plan. So if your employer is not offering a 401k, then there's no real other way to set up a 401k because it's an employer-sponsored plan. If you have funds in a 401k, they can typically be rolled over very easily from a former employer plan, and maybe not so easily or not exactly applicable to everyone that has a current employer 401k. And again, I will break that down and go into that in the next few slides. I'm going to turn my attention back to the presentation. If you do have questions, I see the hand raise feature has been used by somebody. Please use the questions box and I will get to those periodically throughout the presentation, or at the end I have a specific slide to go over all the questions before I wrap up. So getting back on track, the types of plans that can be self-directed, most people are familiar with your traditional and your Roth IRA accounts, traditional being a tax-deferred account, Roth being a post-tax account, meaning you've already paid taxes on the money that's in there and it's going to grow completely tax-free. You do not have to pay taxes on it later in life. You also, with the Roth account, do not have what's called a required minimum distribution, which is applicable for tax-deferred accounts. The basics there are that with a tax-deferred account, you're getting a write-off when you put money into the plan and it's growing tax-deferred, so you're not paying taxes as it grows. But at some point later in life, either when you choose to take the money out or when you retire and need to start living off the money, the IRS and the government wants their cut and the taxes on that money. So it's completely up to you and your tax planner to decide when you want to distribute out of the account, and that money will be added to your ordinary earned income for that tax filing year. Or maybe you want to do a Roth conversion, pay the taxes in a low tax year and move that funds into a Roth account. So those are the basic accounts most people are familiar with. We also have what's known as the SEP and the Simple IRA for small business owners. And also for small business owners, if you're a small business owner with no rank and file employees or no W-2 wage earners, maybe it's just you and your spouse, you're subject to opening up what's called a solo 401k or an individual K plan. Those are great plans for those small business owners. They have much higher contribution limits than the Roth and traditional IRAs. and they have a little bit more flexibility and freedom in the way that they're overseen by the IRS. The other types of plans that can be self-directed are health savings accounts, or HSAs, and education savings accounts, or Coverdell ESAs. I'm going to break down these types of plans a little bit further here in the next few slides. So individual plans, looking at a traditional IRA specifically, anyone with earned income can set up and contribute into a traditional IRA. Your deductibility may be limited based on your annual income. The benefits are you get that tax deduction. It could lower your current tax bill unless you're in the phase-out income bracket. This is tax growth, and former employer plans, which are also tax-deferred accounts in 99% of scenarios, can be rolled in with no tax consequences. With a Roth IRA, again, just as well, anyone with earned income, so W-2 wage earners or any type of earned income, can contribute into these types of plans. And in this case, there's not necessarily a income limit, but when you do make a certain level of income, you may have to contribute into a traditional account and do a Roth conversion. What I just described is often referred to as a backdoor Roth. There's also a mega backdoor Roth. Those are some specific tax strategies that we have educational content on. This is not the time or place for that, though. This is a just basics webinar. So if you're interested in a little bit more of the nuance and niche aspect of Roth IRAs and contributions and rollovers or Roth conversions, reach out to me directly. I can put you in touch with or in front of the right content for you. The benefits with a Roth account are that it's tax-free earnings and no taxation when you withdraw the money out of the account. There are no required minimum distributions, as I referenced earlier. And it's best to do a Roth conversion in a low tax year when you expect to have higher taxes in the future. That's a generalization. Again, please consult with your own CPAs or tax preparers. The traditional to Roth conversion that I just mentioned, it helps you maximize your non-deductible traditional IRA contributions. Everyone's eligible to convert. There's no income limitations. If you have money in a tax-deferred account, you just fill out a simple Roth conversion form and get it switched over and pay the taxes in that tax filing year. You can use that conversion to contribute into a Roth IRA if you're not eligible to make a direct contribution to Roth IRA based on your income. And again, you're able to pay the taxes now rather than later. Maybe you're having a down year as far as your tax filing and how much income you're reporting in that year. Maybe a great year to add the value of your traditional account into that so that you can then not have to worry about paying taxes on that amount later on in life. Employer-based plans, we've got the SEP and the simple IRAs and the solo 401k. These are plans for sole proprietors, independent contractors, anyone that's running a small business with either no employees or a very limited and small number of employees for the SEP and simple IRAs. I'm not going to read each of these benefits word for word, but if you did want to, again, watch the recording or even message me directly, I'm happy to share a PDF of today's presentation with you so that you can go through the slide deck yourself. There are some employees with SEP and simple IRAs that are excludable from the plan, because keep in mind, this is an employer-sponsored plan. So if you have employees, you're subject to allowing them to participate in this plan unless they're excludable, which are individuals under 21, non-resident aliens, union employees. And there are some caveats as well for what types of employees must be included. For those that work a certain number of hours or a certain number of hours over 3 consecutive years, there's credentials there for when you have to include them in the plan, and then the income that they create, or those who received at least $5,000 in compensation during those years have to participate or you must allow them to be included into the plan. The benefits of SEP and simple IRAs, again, they have a bit higher annual contribution limit than your traditional and Roth IRAs. These are employer-sponsored plans, so there's a little bit difference there. They're less expensive to administer and they're relatively simple. Contributions are made into IRAs. There's no fiduciary liabilities. It's a really great product for small business owners that are looking to have a plan for themselves and also set up an opportunity for their employees to start setting aside retirement income or retirement funds as well. In the solo 401k, there's a lot of tons of advantages for those. They've got one of the highest contribution limits in the retirement account world. You're able to defer a lot amount of money of your earned income into the plan, extremely flexible, rollover opportunities. Within a solo 401k plan, you can have both traditional or tax deferred and Roth money in that plan. So it's a really great way to utilize multiple resources and opportunities. They're cost effective as far as administration goes. We offer 3 different levels of solo 401k plan to our client base. There's a real basic level where you're doing a lot of stuff yourself and kind of administering your own plan, but leasing our 401k plan document. We have a level where we provide you the customer service of the client account manager and some basic reporting. And then we have a level where we're doing enhanced record keeping and a lot of the extra reporting and required items for the solo 401k plan. So if you're interested in that, again, specific content in those specific avenues, just reach out to me if you'd like to receive that. So why do people choose to self-direct? Self-direction in itself, people come to it for these 3 reasons primarily. One, it's a new source of capital and you've already been doing a certain type of investing and just learn that you can invest in the same things that you've already been doing with your retirement funds. 2, people are growing fatigued in the stock market. Over the past few years, I've had countless phone calls of people saying, oh, I'm down 10%, 12%, sometimes 20% on my managed account with XYZ custodian. And people are just sick of that. They're sick of the promise that it'll turn, the market will be up when you actually need to access the money. It's just a diversification tool, for lack of better context. Even if you're not moving all of your money to a self-directed plan, if you've got interest in doing a self-directed investment and you're already fatigued in the stock market, that's a key reason we see people switching over, or at least diversifying their portfolio and getting started in the self-directed world, taking kind of a toe in the water to see if they like it and decide if they want to expand that self-directed journey further after that first deal. And then the tax benefits. These are kind of specific to real estate investors as far as your rental income, any profits of sale, like when you sell a piece of real estate owned by your retirement account, they're either tax deferred or tax free. So when you sell a property you own personally, there's subject to capital gains tax, not if you own that property in your retirement account. If you're generating rental income in your retirement account, no taxes to be paid on that. It's basically completely tax-free rental income that's being generated. Now, with respect to that, if you're putting it into a traditional account, you will pay taxes on that money when you take it out of that traditional account or do a Roth conversion in the future. It's super important with self-directed investing to invest with people you know. I'm sure most of you paying attention to this webinar are familiar with know, like, trust. In this specific world, it's very, very important to have that network and have that structure built for yourself, because if the investment you make goes south, there's really no one to point blame at because you're taking the control yourself. So use your network, build your network, check out your meetup for local groups in the investment field or industry you're interested in, your local real estate investor associations, things like that, and just network, ask around, hey, is this a good syndicator that people have done deals with and prefer to work with? Is this person hard to work with if I'm looking to do XYZ type of investment? It's always helpful. I'm going to cover these next 2 or 3 slides and then jump back into the questions. So just a quick reminder, if you've got questions, please add those into the questions box. I'm going to get through about 2 or 3 more slides and then turn my attention to answering a few of those and catching up there. So moving money into a self-direct account, I did allude that I would cover this earlier, so this is the first callback. When you're moving funds into a self-direct account, aside from a new money contribution, which is adding brand new money into the plan, The key ways these accounts are funded are via what's called a custodian to custodian transfer or a rollover, whether that's a direct or an indirect rollover. And I'm going to break that all down for you right now. A custodian to custodian transfer means you're moving funds directly from an existing account into a like account or the same type of account as a self-directed product. With this type of movement of money, it is non-taxable and non-reportable. And really all you're doing is you're filling out a transfer request form with the firm that you want to receive the money. They submit that to the firm that's currently holding the money, and those back offices basically communicate and get the funds moved over. In general, this is a timeline of roughly a week to a week and a half. Some custodians are very fast and will wire the funds over. Some custodians drag their feet and prefer originals. Sometimes they need what's called a medallion guarantee, which is basically a notary in the finance world. Some will not send wires and will only mail a check of your funds, which creates obviously a mailing lag, if you will, and a deposit hold upon receipt of the check. So we're experts in this. We deal with a lot of custodians. As you're going through the onboarding process, I would pretty much ask you, or my colleagues would be asking you, where are these funds coming from? What type of plan are they in? We'll look up in our system what notes we have on that company and give you a clear, reasonable expectation of how long it's going to take to get that money moved over based on where it's coming from. The other way that this money is moved is via a rollover. So a rollover takes place when you have funds in a employer-sponsored plan typically, and you want to move them into a self-direct account. Most times people are tapping into previous employer plans. So whether you've left the military and have a TSP account, you've left the school system and have a 403B account, you've left any other job and have a 401k or any type of employer-sponsored plan, as soon as you leave that job, that money is free and available to you to roll over at your discretion. When you reach out to them to do a rollover, they may tell you you have to take everything. So if you're only planning to move via rollover a portion of the funds, make sure you're aware. They may say, hey, if you're going to move any of them, we don't want to hold the rest for you. We just want you to take all of it. Also, one thing to note, this doesn't happen often, but I have seen it in some cases. If you've left a job a few years ago and just left your retirement funds with them, there's a chance that you're no longer earning on that money, that they've cut you out of whatever profit sharing is going on in that employer-sponsored plan as of when you terminated your employment. So you're really letting them benefit off of your dollars while you're not benefiting any further. So if you're someone in that situation and what I just said kind of perked your ears up, reach out to that employer or that plan administrator and get some more information about what's taking place with your retirement dollars. For example, my wife worked in the school system, and as we were dating, engaged, she finished her degree and left the school system and went into the private sector. And me working in this industry, I asked her about the 403B plan she had, and we found out that it was no longer earning for her as of about a year and a half prior when she terminated employment. And then initiating the rollover process, basically initiating a distribution out of that plan, involved several different back and forth snail mail letters that needed to be handled. So sometimes they, again, try to drag their feet to hold on to their money as long as possible. Sometimes they make it kind of difficult by requiring you to mail a form to say you want to request a distribution, and then they have to reply with the distribution request form, and then you have to fill that out and send that back to them so that they cut a check and mail the check out. So the sooner you get moving on these types of things, the better in most cases. Just finishing the loop on direct rollovers. Direct means you're initiating that distribution and you're having the funds made payable and sent directly into another qualified plan. That is reported to the IRS, but as long as the amount you distribute out of Plan A is rolled over into Plan B, there is no tax consequence. It's simply documented on Form 1099-R on the way out of Plan A and 5498 on the way into Plan B. Now, the other way to roll over is called an indirect rollover. This means you want to take personal possession of the money before putting it into a qualified plan. You're allowed to do that for what's called 60 days from constructive receipt. In other words, if I distributed money out of a plan and the check made payable to me hit my mailbox today, I have 60 days from today, or if it was wired to me and that wire hit my bank account today, I have 60 days from today to put that money into another qualified plan, and I then get the 5498 document saying that I put all the money into another qualified plan and there's no tax consequence. If you pass that 60-day mark, you're not allowed to put the money into the qualified plan. You've effectively taken a distribution and you will end up paying taxes on that money. You're only allowed to do an indirect rollover once every rolling calendar year. So if I did that today and had constructive receipt today, I would have to wait 365 days before I'm allowed to do that again. I want to break down contributions versus earnings, because a lot of people get confused here and think, oh, when I made an investment and it yielded returns and those returns went into my retirement account, that must have been contributions. That's not the case. That's just earnings generated by the investments you make. That does not count against your contribution limits. Your contribution limits are specific to new money that you've generated as qualified income and you're paying taxes on or getting a tax deferral if you're doing a tax deferred account. New money that you've generated from your working and that you're placing into the retirement plan. Completely separate, handled separate, looked at separately from the IRS's perspective. Let me turn my attention, as I just promised, back to the questions box and read a few of these questions that have come in since I've been speaking. Can I use / combine my traditional and Roth IRA to purchase a property if either one does not have enough funds to purchase the property? It's a great question. Yes, you can partner retirement accounts together. In that case scenario, and I believe I've got a case study that explains exactly what I'm talking about later on in the presentation. Each retirement account or each investor into the property, it doesn't have to be retirement accounts. It could be your traditional IRA and yourself as an individual, or your traditional IRA and your spouse or friend or sibling or grandpa's retirement account, or themselves as an individual. When they go into that deal and set up that real estate transaction, the dollar amount they're bringing to the table is a direct correlation of that ownership percentage that's going to be drafted up on the deed of title and through the settlement statement and everything. That ownership percentage is also exactly how all income and expenses have to be split for that property. This is talking about a cash deal specifically. If you're planning to utilize financing and your retirement account's going to be involved, there's a whole separate set of caveats that are included, and that is, again, as I mentioned earlier, something for a different topic and a different day, but reach out to me and I can point you in the direction of that educational content. All right, back on track with the next slide. So here we're going to start going over some of the different asset classes and breaking down some assets just to put in your mind what's possible with these types of accounts. So looking at real estate, which in itself, real estate as an asset class does make up about half of our client base, if not a little bit higher. But in that capacity, there's a ton of different real estate assets that you could be interested in. Looking at actual homes for short-term or long-term rental or fix and flip real estate, that is something that you can own in your retirement account. And again, set up for long-term rental, you can use the local like HUD and Section 8 projects to supplement some of the income and actually help you vet out your tenants. Those are some great resources for clients when they're interested in that. Condos, mobile home parks, or individual mobile home unit. So if you know anything about mobile home investing, you can invest into the entire park, which is a collective, which is structured most commonly as like a private placement investment, or you can actually own a specific mobile home unit where you have a deed of title to that property, that physical, tangible mobile home, and you rent that out as you see fit as well. Tax deed and lien investing is a lane of real estate investing for those that are just trying to dip their feet in the water, or maybe just get started with retirement account investing and don't have a high enough balance to go do a cash transaction on a piece of real estate. We've got some great educational content on tax deed and lien investing. It's a great resource. It usually lets you generate a little bit of income with a high upside of potentially even getting a piece of property in your retirement account if all goes, a grand slam in that specific deal. There's a possibility that you could spend a few $1,000s, a few things work out in your favor, and then you end up owning a piece of what's likely distress, but nonetheless real estate in your retirement account. Real estate investment trusts, or REITs, are often structures utilized for this type of investment where it's kind of a collective trust that's doing the actual legwork of a real estate deal, but that is also an option. And then syndication or private placements for commercial or multifamily properties. That's something we see a lot for larger complexes, maybe a hotel or a motel or new developing properties around college campuses and things like that. Those are usually built by collectives. So there's a general partnership team or a GP team that puts the deal together and does all the legwork. And they usually outsource the funds needed for that, both by collecting lending, but also finding limited partner investors, otherwise your retirement account, to be kind of the cash partner in those types of deals. Paper assets. So paper being a lot of notes, a lot of agreements where this piece of paper is being exchanged for this amount of money, and the terms on that piece of paper are the terms that money is going to be paid back for. So you can have a secured or an unsecured loan in your retirement account. It's important to note when it's secured, it must be recorded for it to be secured for our purposes and context. If you want to sign a secured agreement, but between you and the borrower, you agree that you're not actually go get it actually recorded unless a default event occurs, we are going to hold that as an unsecured note for our records. Tax deed and lien does fall into paper assets when you actually make the investment transaction, but it's still real estate aligned, so it kind of fits into both factors there. Joint venture agreements are great if you have money and you've got a partner with some tangible assets and you want to partner those together and sell it for a profit. You can come up with a joint venture agreement so everyone's mutually agreed on the terms. You do the deal together. Option contracts, let's just say, again, you're starting out with a low balance and you find a piece of property at a great rate. You go put an escrow deposit down, turn around and within your network find someone to buy that contract to purchase that property at that great rate, and they pay you more than you put up for the escrow deposit. You just generated income in your retirement account that's tax deferred or tax free. Other alternative assets, as someone referenced earlier, we see people invest into LLCs. That could either be what's called a checkbook control LLC or a single member LLC, or investing into a larger LLC or partnership that maybe a group of you and your friends are going to do some unique investing. It's a great structure and strategy to do that. There's some unique investments that we see as well. And I'll actually be covering a separate webinar in about 2 weeks on the most unique investments that we see here at Advanta. But if you're a farmer or interested in farmland or timberland, you can own any of that. You can own farmland, you can own farm animals, you can own timber land in your retirement account. You can invest into movie projects. You can invest into equipment leasing like semi-tractors and other types of things like that. Forex and futures accounts, private stock, commodities, oils and gas. Basically anything that's not a life insurance policy or collectible can be invested with your retirement account. And that in itself is foreshadowing because I'm going to break that all down right here and now. The only way the IRS restricts how you invest your retirement account is by labeling certain investments prohibited and certain people disqualified. So prohibited investments include a life insurance policy and collectibles, anything that has a subjective value like antiques, fine wine, alcohol. Here's a quick example. I've got a neighbor up the street that has an old, rusty, beat up 70s Corvette in their driveway. I think it's a hunk that is an eyesore. That neighbor probably thinks with a little bit of elbow grease, they're gonna get that old shell of a car to be worth collector's dollar price at the Antique Roadshow or something like that. Now, that's subjective. If they do put in that effort, sure, maybe they can get top dollar for it, but right now it's sitting in the rain collecting dust and rust. That's something the IRS doesn't want you to hold in your retirement account. Other items here are some coins are allowed for precious metal investors. Again, separate content for precious metal investors. Just reach out to me if you're interested in that. Aside from what I just labeled as prohibited investments, you can pretty much do anything under the sun you want to with your retirement dollars. Again, you just need a self-direct administrator like Advanta that's willing to hold those types of assets, whereas your fiduciaries are going to tell you, no, you can hold the types of assets that we've done due diligence and underwriting on and we think are going to perform. We're not experts in owning a farm animal. We're not experts in investing into a movie project. We're experts in the S&P 500 and this and that, stocks, bonds, mutual funds on the publicly traded sector. The other side of it is disqualified persons. So you're only able to transact with certain family members on the same side of a deal. I'm going to break that down a little bit further on the next slide, but let me just say it again. There are certain people labeled as disqualified persons, and you cannot transact against them. You can't buy something from a disqualified person. You can't sell something to a disqualified person. You can't let a disqualified person be a tenant in a property you own. But you can partner with a disqualified person. You can do other things with disqualified persons as long as you're going into the investment together on the same side of the table. If you think about a closing transaction or you think about any negotiation, if you're on the same side of the table, it's usually okay. If you're on the opposite side of the table, it is not. An extension of disqualified persons as well are any businesses that disqualified persons own or control day-to-day decisions and operations for. So that kind of extends through the person to any business entities they own as well. We have UBIT and UDFI taxes, UBIT and UDFI taxes referenced here. I'm not going to go into those. There are certain taxes that apply either when you're utilizing financing in a retirement account investment or you're generating income that's not so passive. That's kind of an interesting line to walk there. We've got specific content on that, but that's as far as I'm going to go with UBIT and UDFI tax. Feel free to reach out if you want more information or content there. So disqualified persons are just your lineal tree up and down. If you think of a family tree and you cut off all the side branches, just the main trunk, that's what we're looking at here. Yourself and your spouse, and then your children, your grandchildren, as young as you live to see, and your parents, your grandparents, as old as are still alive, are considered disqualified persons. As I just mentioned, business entities they own are, by way of extension, also disqualified. I'm not going to read any of these. These are examples of prohibited transactions. I kind of gave a few examples on the last slide or the slide before that. I'm going to take this moment real quick to read over some of the questions here. A couple additional people asking for copies of the slide deck. I will be happy to get those over to you. Please bear with me and have a little bit of patience. The report of the questions get sent to me, and then I'll have to pull your email address from where you registered and send them to you. So I'll get those to you within, if not the next day, within the next 2 or 3 business days. How would depreciation work if you buy real estate in your self-directed? That's a great question. So depreciation or bonus depreciation is something that is a tax benefit when you make a investment personally. When you're making the investment with your retirement account, you cannot necessarily take advantage of those exact same benefits because you're getting a separate set of benefits by making the investment with the retirement account. So as far as how would depreciation work, if you buy real estate in your self-directed account, differently. There are some aspects of depreciation and bonus depreciation you cannot take advantage of. There are some that you still can take advantage of. That's more so a direct question for a tax preparer or an expert in the depreciation world. I can point you in the direction of good resources for that, but here in this basic educational webinar, I'm not able to break that down more directly or definitively. If the investment is secured notes, why are you referring to it as unsecured? Any reason? I did try to deliberately explain that further. I'll say it again. If the note is labeled and written out as a secured note, it must be actually recorded. We see very often and very commonly people fill out the paperwork, send us the paperwork listing a note as secured, but do not intend to go get the security instrument recorded at the county records. If that is your scenario, we are going to hold it as an unsecured note because you're not moving forward with the intention of recording the security instrument. That is the differentiation there. If we know, if you disclose to us or your borrower discloses to us, hey, we wrote this up as a secured note, but we have no intention of actually going and executing the security instrument, we're going to list it and label that as an unsecured note because you're not effectively closing the loop there. That's kind of the basis behind that. Buying real estate in an IRA is very simple. We help you through the process. You put us in touch with your agent or your closing agency, and we make this as smooth and simple as possible. Just for general information and understanding, the property is going to be closed on in the name of your retirement account through the retirement account's tax ID number. None of your personal name or information, aside from being part of the name of your retirement account, are going to be listed on the paperwork. Your tax ID number will not be listed anywhere. That's part of our job, to make sure this is all accurate and smooth as your retirement account making the deal, not you personally making the deal. All of the funds from the purchase need to come from the IRA or the partners that you're going into the deal for. The purchase must be made, and then the income and the expenses must be split based on that ownership percentage. So whatever percentage of the total closing cost your retirement account's putting up is going to be the direct correlated ownership percentage you have and split moving forward at that point in time. As far as expenses go, you can either submit a copy of your invoices to Advanta or log into your online platform and submit that. That way, we get that process within the same or the next business day. You can also have an authorization on file so that when your routine expenses, like your utilities, get mailed straight to our office as the primary address for your retirement account, which is the owner of the property, we just go ahead and cut the bill and send the payment out to your gas company, to your electric company, to your television provider if you've got a rental unit and you're covering the TV for the tenant, those types of things. If you have a property manager, that's completely your discretion. Understand that a property manager is going to take a percentage and kind of cut down on your margins, but they handle a lot of the extra legwork or reporting or documenting of these types of expenses and so forth, and then they'll just send the residual income generated back to your retirement account on a basis that you agree with them. It's perfectly up to you. If you want a property manager, you can vet them out. You can, negotiate and agree to the terms as you see fit. We're not here to do that for you. Without a property manager, you kind of serve as the de facto property manager. Speaking about serving as a de facto property manager, it's important to understand you cannot do any sweat equity on property owned by your retirement account. So even if you need to change out some plumbing tubes, or even for the purpose of changing a light bulb or painting the walls, you're supposed to get someone else to do that. You personally and your disqualified persons are not allowed to do any of that. It is strictly prohibited. That could be a big problem if you're ever found to have been doing that in the event of an audit. So don't even put yourself in that situation. This does not mean you have to go get licensed, insured electricians, plumbers, whatever it may be. You can just have a handyman that you have kind of on call or ready to help you with those types of things. It can be a non-disqualified person. It should not be a disqualified person that you serve as your go-to handyman. And there's no guidelines to, again, the qualification of work. You're allowed to go on site and inspect the work. You're just not allowed to do anything yourself. So as far as the cash flow, you get to set the lease agreement. Again, you can offsource that to a property manager, but otherwise you get to generate the terms and find the borrowers or the tenants. I'm kind of, when I say borrowers, I apply this in principle to how you would structure and set up a note agreement as well. It's completely up to you. We're not here to oversee it. We're not here to second guess or judge. It's completely up to you. It should be set up to generate some passive income though. So you're not going to want to have an agreement where you're letting someone live basically rent-free in your property you own because it's a friend of yours, it's not a disqualified person. It should be set up so that it's generating passive income. You're not going to be lending a note to someone with a 0% interest rate. You have to be generating some income in some capacity for it to be a viable investment, right? So I've got a few case studies. I'm going to kind of whip through these because we're getting close to the 1 hour mark and I do want to be mindful of your time. So the first case study here is just purchasing a piece of rental real estate in your retirement account. I've got a gentleman here who's got a 401k from a previous employer and he wants to purchase a rental property down the street from his own house. So he opens up and sets up an account. He finds the property and makes an offer to purchase the property in the name of the retirement account. If he's still setting the retirement account up, you can make the offer to purchase it in your name and you can even put up an escrow deposit so long as you do an amendment or an addendum. An assignment is not allowed because of disqualified persons rules. An amendment or an addendum conveying the purchaser to your retirement account, and we overfund at closing by the escrow deposit amount so that that gets returned to you personally. Those are key things to note for real estate investing. You'll pretty much see that in any of our specific real estate investing content that we put out. Addendum or amendment, assignments not allowed. Earnest money can be put up so long as we overfund and that gets returned to you at the closing table. Once you have that all in order, you submit the purchase authorization paperwork through your account manager. You submit all of the documents. There's a typo here that says loan documents. It's meant to say closing documents. As long as it's all in good order and we collect a written approval from you, meaning you've authorized everything to be executed, we will work directly with the closing agency. We'll execute all the paperwork. We'll wire the funds to closing, and then we will make sure that we receive and hold the original recorded deed for as long as you own that property, and we'll facilitate all the income and expenses of that property moving forward. Just some rounded numbers, but a completely possible result here. That property was purchased, and did I mention on the last slide the amount? The amount's not referenced. I think in this case study, the property was originally purchased at $150,000 or $120,000, just to make the numbers make sense here. The property is rented for $1,200 for 2 years. So that generates $28,000. The property is sold after 2 years for $170,000, and that generates $50,000 in profit. So no taxes are paid on the $78,000 of profits realized. Again, calling back to something I said earlier, there's no capital gains to be paid. And that money is now just in the retirement account. There's $198,000 that this person can reinvest as they see fit. Next case study is investing into a syndication. Again, a limited partnership where some team of general partners that you're doing the vetting on and you're reading their prospectus and their memorandum, they're doing the deal, you're putting up the money with expectation of the returns they're all but promising you. So in this scenario, I've got a gentleman that has an existing IRA somewhere. He meets a syndicator or a general partner who's got a deal put together, and they go over the paperwork, go over the expectations for the deal, the timeline expectations, the return expectations, and the guy decides he doesn't want to join the deal. A lot of times with these types of deals, you'll see a minimum investment of about $50,000. Sometimes they're down to 25, but a reasonable expectation is to think if you want to invest into syndication, you're looking at about a $50,000 threshold at minimum. So this gentleman opens his account. He conducts a custodian to custodian transfer to get the money moved over. He submits, or we submit the transfer paperwork and let him know when the funds arrive. All the while, we can start working with the syndicator to get the investment paper and get this person to approve it all so that as soon as we have the money, we can go ahead and turn around and execute the transaction. Again, all the subscription paperwork is going to list the retirement account as the investor, the retirement account's tax ID number. It's deliberately not going to have that investor's personal name aside from within the vesting of the retirement account or the accurate name of the retirement account. And it's not going to have his personal social security number for any purposes at all. And in this scenario, again, $100,000 investment, it's paying 8% preferred distributions to all subscribers on an annual basis. In the 5th year, it's refinanced, which is a very commonplace in these types of deals, and a lump sum of 130 is sent as a final payout. So over the course of 5 years, holding $100,000, this investment generated $40,000 of preferred distributions and a $30,000 lump sum in addition to the return of the principal. That's $70,000 generated over 5 years for that asset to be held. Again, rounded numbers, maybe not exact to every scenario, but just an explanation and a gist of what's possible with these types of investments and strategies. Next one here, breaking into real estate again, partnering on a deal. So we've had a few questions in today's presentation about partnering. I'm going to break it down a little bit further. We've got Linda and Paul. They'd like to partner their IRAs to buy real estate. They each have $100,000. They find a property valued at $150,000, and it's going to need about $20,000 in repair work to get it rent ready. They estimate it's going to generate $1,500 a month in rental income, which is obviously going to split into their retirement accounts. So they both open the self-direct accounts. They get that property under contract for purchase. They get all the paperwork ready and the funds moved into the self-direct accounts. We, on the back end, facilitate the closing transaction, make sure their ownership percentage is split. I believe in this example, I'm doing a 50-50 split. I'll check on that next slide. But we facilitate kind of everything, all the legwork on the back end. The full deed of title as tenants in common is going to list the first retirement account as to X percentage undivided interest and the second retirement account as to Y undivided interest. In this case, it's 50-50. It could be any split possible. I've seen husband and wife do 95-5. I've seen people do 50-50. I've seen 7 different investors all on the same property. So it's basically, again, just set. I beat this one home. It's set based on the percentage going to the closing cost. Once the purchase is made, the ownership cannot be changed if these are disqualified persons. If they're non-disqualified, sure, you can sell some of your portion to a non-disqualified partner and exchange in that capacity. But if they're disqualified, my retirement account can't buy from Linda's retirement account any portion of this property if Linda's my wife or any other disqualified person for that matter. And the final case study I'm going to cover today is using checkbook control. Just to briefly break down what checkbook control is. This is an LLC that you set up that is wholly owned by your retirement account and that you are the manager of, such that you can establish a bank account in the name of this LLC that is funded with your retirement account's dollars, and then you have check writing power or a debit card to make whatever investments you want to do with it. With this strategy, you're not having to come to Advanta when you want to execute a transaction. So this works well for investors that are trying to move a little bit faster and outside of normal working business hours to conduct their deals. But it does put a little bit more onus on them to make sure they're not conducting any prohibited or otherwise disallowed behaviors or activities. So we're still here as a resource, but we're not a big brother on your account. We can't see what you're doing with that checking account. It's up to you in good faith to not conduct anything prohibited and have a good, clear understanding of the rules. So with this setup, you basically bring to the table an operating agreement and a registration with the IRS that shows you've established the LLC in the state of your choice and have a tax ID number, so that we can invest the transaction where your retirement account is investing into that LLC. You provide us the banking information and we'll cut a check or an ACH or a wire into that bank account. And then you, as the manager and or any other managers you appoint, control that bank account and control that LLC as you see fit. A lot of this is just kind of breaking down some of the information that needs to be applied. In the operating agreement, it does need to show that it is a manager-managed LLC and you are the manager or any other appointed managers. It does need to indicate that it is 100% owned by the retirement account. You can do multiple member LLCs, but it's not the exact same and it's treated slightly differently. Again, a little bit bigger concept for a different conversation or a different webinar, which we have. Just reach out to me if you want that content. And the only other thing I really want to break down here is that the LLC cannot have a line of credit. So you personally can have a line of credit, but you personally are not your retirement account. Your retirement account is not an individual, so it cannot sign a line of credit or a personal guarantee or anything like that. So make sure that you're only sticking with debit or checks in this type of account. You cannot open a line of credit. As I referenced earlier with real estate, when you're involving finance, there's a whole nother can of worms to be opened if you want to utilize financing or leverage with your retirement account. This is supported in case study and in case law that you're allowed to serve as the manager of your own LLC. If you recall the prohibited transaction rules that I mentioned earlier, you may be thinking, oh, how is it allowed that I can be the manager and have managerial responsibilities and duties for my retirement account if I'm seen as a prohibited person or disqualified person to my retirement account? Well, that's been sorted out in case law. In 1996, there was Swanson versus Commissioner, where he was deemed, Mr. Swanson, to have conducted prohibited behavior by serving as his own manager. He took that to court and actually won, indicating that as long as you're not compensating yourself for the activities you're doing as the manager of your IRA's LLC, it's perfectly fine and allowable. You're just being a steward of your own retirement dollars. Again, you cannot compensate yourself. You can't, buy yourself lunch out of the retirement accounts funds because you have the debit card for the LLC. You cannot give yourself a salary for the work that you're doing. You're doing it to benefit your future earnings or your future self. And then the TL tax court memo for Mr. Ellis, TL Ellis tax court memo in 2013, further stipulated and further clarified, yeah, you can't give yourself compensation for what you're doing as the LLC's manager. Just to share with you as we're rounding home here, we put out a lot of educational content. We do typically 2 of these educational webinars a week on Tuesdays and Thursdays. Our full library of the past several years of these types of webinars can be found on YouTube. We have a blog as well if you're interested in some of the industry standard news. We're getting into an election year, and oftentimes there are some legislation that gets thrown around that impacts our industry. So if you're interested in that, check out our blog on our website. Not listed here, but also very viable and resourceful is our podcast, the Alternative Investing Advantage podcast. My colleague Alex Perney hosts that. He has great experts in their fields of investing and industry as guests on that podcast. So check that out if you're interested. Anywhere you find your podcast, the Alternative Investing Advantage podcast by Advanta IRA. Getting one of these accounts set up is very quick and easy. It takes you about 15 minutes to complete our application. After a simple conversation with myself or one of my business development colleagues, we'll get the application over to you via DocuSign. You can get that knocked out within 15-20 minutes, get your account open, get that account funded as I went over today in roughly a week and a half. I'd say conservatively speaking, give yourself 2 weeks just so you're not, pushing any limits or deadlines. And then you can start investing really quickly, really easily into whatever you have interest in and you want to invest into. I hope today's webinar has been helpful for everybody. I'm going to just peruse the questions box one more time before I wrap up. And while I'm doing that, I'm just going to leave you with my face here and my contact information if you want to jot that down. How does one pay for expenses if your SDIRA doesn't have enough funds to pay for the repair? Don't put yourself in that situation. Make sure you've done your due diligence and your underwriting and you have enough money to cover those types of expenses if they come up, because if you can't pay for it and your retirement account is the only investor, your hands are pretty much tied or handcuffed and you can't get that repair done unless you get into the muddy world of borrowing in the name of your retirement account, or wait until you're eligible to make a new contribution into the plan or roll over or transfer more money into the plan to cover that type of repair. Can I sell my rental property to my SDIRA? Absolutely not. If you own a piece of property personally, you're pretty much never allowed to have that piece of property in your retirement account by way of disqualified persons rules. Some people say, oh, well, what if I sell it to John Doe and then John Doe sells it to my retirement account? That's what's called a step transaction or an arm's length transaction. You may get away with it in the moment, but if you're ever audited in the future, it's a clear-cut red flag. You're going to have a lot of problems come after you at that point. Basically, if you are found to have done a disqualified transaction or prohibited transaction, your IRA ceases to be an IRA as of the beginning of the calendar year that that transaction took place. You basically forfeit all the tax write-offs and tax benefits. You get fined, you get penalized, and it's not a situation anyone wants to be in. So don't try to create a workaround for it. It's just not possible. In case study 3, what if the partner does not have an IRA account? That's perfectly fine. You can partner with individuals, you can partner with business entities. As long as you're partnering, even if it's a disqualified person, you're going to that table to do the deal, and you're on the same side of the table as any disqualified persons or whoever you're on the same side with. It's perfectly fine. It can be a business entity, it can be an individual, it can be another retirement account. Perfectly fine to partner. We have other educational content on partnering. Check out YouTube or reach out to me directly if you want some of that. Can the LLC be based abroad? Yes, the LLC can be based abroad. We've covered that in some other educational content as well. The rule there is you're going to want to reach out or do your research on if that country or that jurisdiction allows a retirement account to be established. I've seen people set up their checkbook control accounts in countries in South America. I've seen people interested in checking accounts in checkbook LLCs in countries in South America that country disallows it. So that is part of the due diligence that the self-direct account holder would need to do. What is the fee for SDIRA account? Reach out to me directly. This educational content is being recorded and is going to live in perpetuity on the internet. So I would prefer to tell you one-to-one. Very open about it. I'll email you our fee agreement in a response to your reaching out to me. I'm just not going to disclose that out loud because someone could see this 10 years down the line. Granted, we've very had limited changes in our fee agreement over the past 10 years, but nonetheless, that's just for a different point in time. And the last one was just a thank you. So awesome. I appreciate that. I thank you all for being here with me. And again, reach out to me if I can help you any further. If you're already connected with someone at Advanta IRA, reach out to your point of contact if applicable. Check us out on our other educational content, and have a great rest of your day.